Hello everyone, welcome to the channel where, as always, we inform you and we educate you. In today's video, we're going to talk about how does indexing work in an index universal life policy. Now, years ago when I used to sell fixed index annuities for various companies when I worked at the bank, I used to wonder myself, how is the insurance company able to pay extra 6%, 8% if the stock market went up or the S&P 500 went up when my money wasn't invested in there. You know, the client's money wasn't invested in there, but they were able. I used to wonder that. Well, if you were wondering that, today you're going to find out. All right? So let's dive into it. So an IUL, which is an Index Universal Life Policy. All right, that's what it stands for. And if you're not familiar with it, I created a video where I go in depth at how this works. But just to give you a brief summary, it gives you flexibility where you can actually benefit from the index going up, like the S&P 500, and when it goes down, you don't lose anything. So it has a ceiling and a floor. So you'll get to participate in the gains, but when it loses, you don't lose anything. Your floor is zero, so you get nothing. All right. So that's how that works. So now, how is it possible for you, if your money is not tied up in the market, how is it possible for you to share in the gain? So this is how it works. The insurance company, when you pay a premium, they're going to invest your money. They're going to invest the money so they can get money. Their tier one assets, most of their money is going to be in bonds. And that's where the guarantee money comes from. They invest in bonds, stock options, real estate, so different investment. But the majority goes to safe bonds, right? So when you have a whole life policy and they're able to guarantee you 4%, that's how they're able to do it, by getting it into bonds. So that's where that area is the general GAP, the general account portfolio. So that's where the general. So that's why they can give you 4% in the general account portfolio. A lot of people don't know this, but you also have that option within Index Universal Life. This is why I love an Index Universal Life, because it's flexible. If I wanted to, just like a whole life where every year I'm guaranteed 4%, if I wanted to 1 year, say I want to take this, I can do that. I can say, just give me the 4% this year. I don't think the market is going to be bullish. Give me the 4%. You can do that. So it has flexibility, right? So that's 4% in the general account portfolio. That's how you're able to get that guaranteed 4% in a whole life policy. So what does that have to do with IUL? In an IUL, when you're doing the indexing, that 4%, and I'm just using 4%, it could be 3%. Interest rates are crazy now, so whatever, but typically 4%. So that 4% that you would have gotten in from your general account portfolio, what you're doing in an IUL is telling them you can go use that 4% to purchase stock options. All right? Now, you don't have to understand how stock auctions work or anything, but the insurance company knows how they work. Insurance companies and banks purchase the most options. Okay, they put the most money there, millions, millions and millions of dollars. All right, so buying up options. So they're going to. You're telling them go use that to buy options. Now, if they were right and it went great, let's say it went up 20%, you get to share in that. Whether you have a cap of 15 or some insurance company will allow you to have uncapped years, meaning if there was 20%, then 20%. You know, they do get a little off the top there, you know, maybe 3%, 5%. But let's say it did 40%, you're able to get most of that. You know what I'm saying? So you could do that. So you're able to get that if they guess right. You're able to share in those gains. Now, if they did wrong, if they guessed wrong and they lost, right? The market went down. They didn't do well. Then you didn't lose anything. All you're doing is giving up that guaranteed 4% that you can get. You can choose to get if you want to, and telling them go buy stock options, and you just lose that 4%. You just didn't get it. But you didn't lose anything. If you had $1 million in the account, you still have $1 million, right? And if you gained money previously, you don't lose any of that, right? Because you're not unlike other vehicles where you invested in the stock market, you're not actually invested. That 4% that you could have gotten for that year, you're giving that up and saying, hey, go buy options to give me an opportunity to make a lot more. All right. But if it didn't work out, then I don't lose anything. All I did was gave up that 4% that I would have gotten had I went the conservative way and said, give me that guaranteed 4%. But if I had $1 million in there, I still had $1 million in there, right? I just gave it up. So I hope that makes sense. So that's how they're able to do it, right? What you're essentially saying is that instead of giving me a guaranteed 4% this year, and like I said, you can do this year to year. You can say 1 year, give me that 4%. The next year, give me index. The next year, give me index. Most of the times, it's going to work in your favor for index. So most years people will do that. But some people have an idea or feeling of how the market is going to be. So they might say, hey, in this particular year, just give me the 4%. But you can give that up anytime you want each year and have the opportunity to make a lot more, 30, 40% sometimes. Okay. So that's how it's done. All right. So I hope that makes sense to you guys. I hope that answers some questions for some of you who are wondering how is the insurance company able to do that. But that's how they do. So just to recap, right? You're giving up your 4% from your general account portfolio that you would have had, your guaranteed 4%, and you're telling the insurance company, go and purchase stock options in whatever index it's tied to, and if it does well, you will have the opportunity to get the gains from that. If it doesn't do well, then you just gave up that 4% that you would have gotten, but you lose nothing from what you already had. Hope it makes sense to you guys. As always, if you have questions, please reach out. Place a comment. You could put your question right in the comment section right there. And as always, if you did find the information valuable, I'm going to ask you a favor to just like the video and share it with someone that you think could use this information as well, because that's what it's about. It's about enough people getting the information. And if you haven't already done so, make sure that you subscribe to the channel and hit the notification bell so that every time I make a video, you're the first to be notified. Until next time, I'll talk to you soon.